Let me now welcome on board Ashwini Agarwal and find out what he's making of the year gone by and what 2026 may have in store for us. Ashwini, hi, good to have you on the show. Ashwini, we often keep talking about here on the ET Now newsroom as to how flat the year has been for the Nifty. The stark underperformance, of course, from the mid and the small caps. That's been the highlight of the year gone by, right? Especially the latter part. How much of it could change, Ashwini, as we step into the new year?
Aisha, thanks for having me here. I think it's a great question. And, my mind travels back to September of 1994 when the markets had made a high of, with the BSE Sensex at 4,200. Stocks were quite expensive, and we were all very young greenhorns, and we would put out reports with price targets at 20 times price to earnings multiples. And the next, 3 to 4 years are very challenging because the economy went through a significant, squeeze because a lot of the NBFCs went out of business, liquidity remained tight. There was a Russian crisis and the Asian crisis during that time. The point that I'm trying to make is that, while 1 year seems like a very long period of flat returns, history tells us that this could be much longer. And the reason to my mind is that earnings growth is still elusive. We are all hoping that fiscal 27 will see some improvement in earnings growth with all the cuts in GST that have been put through with easing of liquidity that's happened. But at the same time, there are imponderables out there, which include, continuing weakness in the INR if gold and silver continue to appreciate, and potential one-off risks from overseas for investor sentiment if all this AI bubble starts deflating. AI is here to stay. I have no doubt in that. But a lot of the investment that's being made is probably not going to bear fruit. And that, I think, will be painful for stock prices. Now, whether that will happen in 26 or 27 or 28, I have no idea. But we are looking at risks out there. And at the same time, there is hope that earnings growth will revive. And in several cases, stocks are down 50, 60% from the highs that we saw a year ago. So on a bottom-up basis, there are opportunities, but on a broad market basis, I think I wouldn't be terribly surprised if we saw another year of +5, -5 and ended up nowhere.
How do you protect capital then, Ashwini, in the year ahead?
Asset allocation, I think, is the only way one protects capital. So you have a mix of equity, you have a mix of debt, you have some exposure to commodities, metals, and some real estate, then that's the only way to go. One of the most underappreciated asset classes that has come into the Indian markets over the last 6, 7 years is the REITs. And I don't know how many retail investors have looked at this asset class closely. But it's a very good combination of some growth with some yield, and it tends to protect value. So, and then you have, of course, the metals rally, which is essentially a weak US dollar trade. So you have to put these into the portfolio mix. So, that's how you protect value. And the other way to protect value is to go bottom-up stock selection. Now, for a lot of your viewers who invest via mutual funds, that may not be an option, and I wouldn't recommend people to attempt bottom-up investing if they are not full-time professionals who are in the business of investing. So that's going to be a tricky one. But I think asset allocation is the real key in my view.
Ashwini, hi, this is Harsh here. What is it going to take for you to likely change your opinion? Is it going to be faster earnings growth, which will surprise you, in your opinion? And I'm talking broader markets here. You've spoken about bottom-up stories where there are opportunities, and I'll come to that. But with regard to the larger market, will it be an earnings revival which will likely drive your conviction, if at all that were to play through? And if so, what will it be to surprise you?
So two things. I'm looking for earnings growth improvement. So if the earnings momentum starts to improve, let's say in December and then following in March, and we start to see a trend of stronger earnings emerge, I think that would be something I would welcome. The other thing that we need is the INR to stabilize. Now, for that, I think one of the elements that we need to see is to see the precious metal prices, the gold and silver, stabilize. The INR weakness is a huge negative for foreign inflows. People invest in emerging markets so that they may make money. And what they don't want to do is make money in the underlying stocks or the underlying economy, but lose it all on the FX. So I think we need stabilization of the INR and we need earnings growth to emerge. You need both of these to happen for me to change my view, and it can happen. I mean, both these factors are possible. I mean, as if let's say over the next 2 to 3 months, we all come to the firm conclusion that the rupee is now going to be stable for the next 1 or 2 years. So whatever factors might emerge, it might be weaker crude, it might be finally the U.S. trade deal being signed. There could be a host of factors which lead us to believe in that. So that I think would be positive for foreign inflows. That would be encouraging. And what you would need is an emergence of earnings growth for the broader market.
Mm. But I mean, and correct me if I'm wrong here, Ashwini, I don't think there is dearth of FII money here. Look at the IPO subscription, look at the blocks. So, I mean, money is there. There is enough liquidity buying India. It's just buying it through other means, right? And do you sense that this could continue very well into the new year? You've got some very large IPOs in the pipeline for the next year too.
Yes, see, the IPOs will continue, and some of these IPOs are large and good quality offerings, and which investors are interested in, and rightly so. But what's happening, Aisha, is that they're being financed by selling down of existing holdings. So fresh new capital from foreign sources is quite limited. Again, even if you take private equity into account, you have to net out what they're taking out and then see what are the fresh inflows. I think commitments are there. I think the interest is there. But I think valuations and lack of earnings growth, as well as a weak INR, have been dampeners. So if these factors correct, then I think you will see a lot of positive momentum. For the moment, I think IPOs will continue. For the IPOs party to end, we need a spectacular IPO to go terribly wrong. I mean, every bull market ends with a large IPO, not making any money for investors and dampening the sentiment. I haven't seen that till now. There have been a couple of IPOs that haven't done so well. And of late, if you see the percentage of IPOs that are in the green, say 3 or 4 weeks from the listing date, are declining. But I think the sentiment hasn't broken yet. So I think the IPO party continues for the time being.
Yeah, and Ashwini, you were talking about those bottom-up stories. Do you think that's what's
Yes.
at play when it comes to IT largely? Or do you sense some sector tailwinds in place now, other than the rupee?
So, one of the things that I've been wondering about in IT is that is the use case for AI for IT services in particular underappreciated? What I mean is not that they'll help clients implement AI as a service offering, which obviously they will. But I think there's an opportunity for IT services to take out costs using AI, especially at the bottom of the employee pyramid. And I think that might be something which is underappreciated. And let's see how this evolves. This is just a thought at my end for the moment. I'm not playing it, but this is a possibility because they're putting a lot of effort into training AI engines within for the projects that they're implementing for their clients. And I think one outcome of this could be that margins improve even if sales growth remains fairly slow, or billable hours remain fairly slow. So what you might see is margin improvement or margin lift coming out of AI for IT services. I mean, that can happen.
Okay, Ashwini, great to have you on the show. And here's wishing you a happy new year from all of us.
Thank you. Same to you and to your viewers. Thank you so much.
Let me now welcome on board Aman Chauhan from Abacus Asset Managers LLP to talk about what he's making of the market right now. Aman, hi, good to have you on the show. Aman, just looking at how the year gone by has been, and I was just chatting with Kunal, my chart is that you can just draw a flat line, just a few odd spikes, and that's largely what we saw in December. Do you think the year ahead could be as quiet?
Definitely not. It's been one of the rare years where India is not relatively outperformed. When you see a flat chart, many people will be happy that okay, they didn't lose money. But on a relative basis, we are amongst the bottom performers, like even the bottom quartile, right? All other markets are up double digits, or even some markets are up 20-25%, right? From that perspective, I think markets took a breather, good 3-4 years of rally, 1 year of time correction, or as we say, recharging the mobile phone kind of phenomenon. Once the tariff issue is behind us, which can be as soon as January, we thought it should happen in December, but we are already past mid of December. I think the US is soon going to go on a Christmas holiday. So December looks unlikely. If it happens around Jan, I think post that market should start to pick up because domestically we are doing well. Economy is catching up, things are getting better. So that's what I feel. Definitely not a flat year, but in 26.
Aman, when will the mid and small caps get that supercharging?
A few months of rally, and then they'll also start the party. It doesn't happen that only large caps rally. There can be periods where only mid caps rally and large caps take a time to come up. But if large caps continue to do well, mid caps soon join the rally. So I don't think that should be an issue. If markets do well, I'm sure mid caps will also come in.
Okay, Aman, this is Harsh here. Aman, give us a sense. Your positive metals, cement, real estate, chemicals, all of those are largely cyclical. What are you most bullish on within all of these cyclical sectors?
So we are definitely positive on metals. We are more positive on pharma. We are also positive on domestic industrials. Not very much on cement or real estate, but more on, you can say, infra. Domestic growth is what we are banking on. X of consumers. So consumer sector will also do well. Clearly, there's a government focus to improve the consumption there. But valuations there are something that is not very attractive to us, and hence we are more towards the manufacturing side of the economy. But these are the sectors that excited besides financial. So financial is something that is, I believe, a consensus call. Whatever rate cuts have happened, the benefits of that will start to look in from next quarter onwards, and that's something that is exciting to us also.
And Aman, what within financials? I'm curious of that. There's just so many ways to play it.
So we are predominantly into large private banks, large PSU banks, top 1 or 2 PSU banks, more of NBFCs. So for us in the portfolio, there will be equal weightage of NBFCs versus what the banks are, and non-funded financial also. So we would have some AMCs in the company, some wealth management companies, right? So between the three segments, broadly we are equally divided. So non-funded financials, top PSU banks, and large private banks. So that's broadly where the financial focus for us is.
Aman, I'm quite curious to know how is it that you're looking at IT? Because I remember you guys were at Abacus were the first ones to actually turn bearish on IT. We all saw what happened to the sector in the last 2 years. But now do you think there is material reason on the ground to become bullish on IT? Or would you say that this is just a catch-up trade?
We are neutral on IT. We are not bearish. We feel the larger companies will now report only single-digit growth because of the size. These are great companies, great businesses. Macro also is good. But even if macro improves, the 4-5% growth that they had in the last 1-2 years is going to improve to 7-8-9%, which is still going to be single digit, which is not exciting enough as a growth investor per se, right? The mid-cap IT is interesting. That is something which I believe one needs to be selectively picking up, and our focus is there. So we have trimmed our large cap IT exposure, but holding on to the mid cap IT that we have. We are not very overwhelmed because this is no longer a high growth sector. There will be currency benefits, but once the growth comes in, once the AI does or the digital transformation which the global worlds are going through starts to flow to these companies, the growth rate picks up, we will be looking forward to these things. Till that time, you can say neutralish stance.
Aman, Abacus is known for value-conscious growth, right? And therefore, what gives you? Where are you more tilted towards? Are you more tilted towards mid-small caps at this point? Large cap compounders, is that what you're looking at? Because you hinted towards large cap compounders within the financial space, but how are you playing the mid small cap, and whether at all you are playing that theme as well? Give us a sense.
I think we are equally placed on both sides. We never have this debate large cap versus mid caps. For us, at any given point of time, there will be some large cap which makes sense, there will be some mid cap which makes sense. Depending on where the value is, where the earnings growth cycle is, we'll invest. So today, I'll say it is balanced. It's not that only large caps are giving me value conscious approach of investing and mid caps are not. There are good amount of mid caps also where we continue to invest. So we are investing into NBFC, which are mid caps. We are investing into auto ancillary companies, which are mid caps. Some chemical companies, which are mid caps. Some platform companies, right? So for us, it's not a large cap versus mid cap debate anymore. So we are finding value both large and mid as we speak.
And Aman, you spoke about tech companies. So within that, especially the new age tech, how does one justify the kind of valuations they currently trade at? And if so, even with the higher growth, how do you pick the winners?
For a long time, we were conscious of this sector's valuations and we were not heavily invested into this sector. In the past few quarters, we have started to look at these companies positively because many of these companies have now turned EBITDA positive or the cash burn in these companies have gone. And hence now it makes sense for us to look at these sectors, right? Obviously, these companies need to be looked from a different angle of valuation matrices. The traditional DCF or a PE or a PEG is not going to work because these companies can grow rapidly for a long period of time, right? So one needs to take valuation from that point of view. So if you're having a company which is currently a monopoly or a duopoly in its segment, then that company will trade at a significant premium versus the traditional sector because here you are getting into a high market share scenario and that high market share is going to sustain for years and years to come, right? So obviously these companies will trade at a premium. So we need to balance it out. So we are okay to pay a premium, but still prefer companies which are not burning cash or which are profitable.
And that, duopoly, Aman, like you rightly said, is playing out in a whole lot of sectors. I mean, everything from QCom to telecom, many sectors are seeing that kind of a defining trend.
Yeah, and we are now getting opportunities. And every month there's a new age company that is getting listed. Every week there will be some other company that are getting listed, which could be interesting. So from that perspective, the investable landscape is also increasing. And as I said, some of the companies which used to burn cash are now turning positive also. From that perspective, the investment landscape is clearly very attractive. And lots of monopolies and duopolies have also got listed across sectors, right? So now we are waiting for some fintech companies to get listed. There could be one or two new commerce companies which can again come into the market. That's where the excitement is, and I'm sure markets will pay a premium for these names.
Aman, is that the trend really? While in the Western and the Far East, it's all about AI. But for us, you think the AI play is consumer tech, if I can broadly classify it as that?
You can say so because we don't have a direct AI play or we don't have a large AI play or a direct AI play in that sense. So for us, platform companies are where you can see rapid growth. Why do people prefer AI? They prefer AI because that's what the future is and that's where the rapid growth is. The same thing in India is this is where the platform company, this is where the future is, this is where the rapid growth is. So that's, you can say, India's alternative to AI.
Okay, Aman, great to have you on the show and thank you so much for your time. And here's wishing you a happy and prosperous new year from all of us.
Sure. Great. New Year greetings to you and your viewers also.